I have some links to present value tables here, I think. And I can share an Excel for this class with everybody too. But for your test, you just have to be able to use the Excel. And I'll share the link with you after. So facts and circumstances. If we have a $1 million 10-year bond with a 6% stated rate, valuations at the market rate of 4% and 6% and 8%. Let me share. I'll just make a Google Sheets now with you. Go over how you can do this. Oh, we have the accounting sheets. Does someone share this with the class if you still have access? Present value. So we have future value, term, periods, semi-annual, stated interest rate, annuity, annual market interest rate, semi-annual market interest rate, and bond value. One, two, three. That's $1 million. Par, discount, free. So if our annual term is 10, so we're saying this is a 10-year, $1 million, 6% interest bond. What we actually are saying is there's 20 periods. It's semi-annual periods, right? That's the first piece we need to assess. We're paying interest twice a year, and so we're going to calculate our net present value using the number of periods. That's just how the calculation is done. That's just a fact. The stated interest rate doesn't change. It's going to be 6%. That's on the face of the bond, right? That doesn't change anything. Our annuity is the semi-annual interest payments. Annuity just means a set amount of money, a fixed amount of money paid periodically. That's what the term annuity means if you've ever heard about it. So annuity would be we have 20 periods. We have that. Let me make this a little cleaner. So we have to do everything by the amount of periods, right? So because we have a stated interest rate of 6%, our semi-annual interest rate is 3%, right? Every 6 months, we're paying 3% interest. Does that make sense? I know there's some questions in the chat. I'm going to get to that after I go through this model. So to figure out our semi-annual interest, we take our million times 3. So we're going to pay $30,000 a year. I mean semi-annually, $30,000 every 6 months or $60,000 a year. So what if we say 4%? The market interest rates can change at any given time. 4%, 6%, 8%. We also have to divide this into periods. We're always going to give interest rates in annual terms. It's always going to be annual. So the semi-annual rate we have to determine by just dividing it by 2. We can then just use the calculator here to determine the present value. We do PV comp for parentheses. Let's see. PV present value of an annuity. Normally it should give me a prompt. So PV formula, Google Sheets. Saying PV, this is the formula. How to read this, we're saying the present value function. Present value function is going to take the rate, that's the market rate, times the number of periods. Number of periods are 20. We've determined this. We're going to take the payment amount. We know that's $30,000. And we're going to take the future value, which is $1 million. And that gets us our present value. That's what we'd be willing to pay today for these bonds that have these characteristics. So if there's a future value of $1 million, an annuity of $30,000, and the current market rate is 4%, and we're stated interest rate is 6%, we'd be willing to pay the premium, or the premium discount. We'd be willing to pay a $163,000 premium to get that extra discount, to get that extra interest rate. Here, we'd want a discount for the lower interest rate. There's a way to do this with present value tables too, which I have here. I'm going to go through it quickly just because you'll hear about it in the future. But the present value tables, we have two cash flows. We have the present value of a future amount. That's what we're saying here. Right? We're saying we're going to receive $1 million after 20 periods or 10 years. And we get the $30,000 of interest semi-annually. We have to value those separately. So you're going to use two different types of table, a present value table and a present value of an annuity table. We need to present value the future amount of $1 million. And so this goes back to what you were saying, Saeed, is what is that $1 million worth today? That $1 million, we would take it, let's say at the 2% rate for periods. So we're saying the market rate's 4%. We need to divide it by 2 to get to a semi-annual. And so we'd say 20 at 2% is a factor of 0.6730. That gets us our, we'd multiply this out. We'd say $1 million in 10 years is worth $673,000 today. In another way, we're saying if we had $673,000 today and invested at 2% semi-annually for 10 years, we'd have $1 million in 10 years. And that goes to show you why the rich get richer. That goes to show you why investing is important. And the earlier you invest, the more you make money. You'd almost double your money in 10 years, right? But that's not all. We also get an interest rate here. So we have to also value the $30,000 annuity payment. The $30,000 annuity payment would get which is the $60,000 of interest divided by 2. We just take it by the annuity table. It's a separate factoring table. 20 periods by 2% interest. And we take the 16, this factor multiplied by the 30,000 to get 490,000. That gets us the total present value of the bond at the 4% market rate, which you can see is the same, about the same. This is a little, it's maybe like $30 difference. That's because this is more accurate. The Excel is more accurate. Two different ways to get the same answer. This is a lot. I'm not expecting you to grasp everything I just mentioned. I want you to get the high level. You're going to need to watch the video again. I have this lecture saved again. I expect you to practice through the homework. The good news, I went through this because I want you to understand it and I want you to have the tools. What I'm going to be asking you for is this. I'm going to let you know, hey, is there a premium or a discount? I'll let you know what that amount is on the test. And I'll ask you generic questions, more like this slide. Where is it? This. Are we selling at a par, discount, or premium? I want you to understand that. Are we selling at a par, discount, or premium? If we are, what's the journal entry, which ties to here? If we buy it at a premium, what's the journal entry? The premium is this going to be, we're going to get our cash, debit cash, we'll credit bonds payable, and then there's going to be a premium to bonds payable, which you'll see in the slides. What else? We'll talk about the issuance of it. So get cash, credit bonds payable, and we'll credit the premium. And then I want to focus on like the definition of what is the bond, when is the valuation of the bonds occur, and what's the difference between stated rate and market rate, and all the terminology here. The terminology, where's my term? Here. That's where I'm going to be focusing higher level. I might ask you also about the terminology on the valuation that we talked about. Like, what does net present value mean? I'm not going to, on your final, I'm not going to test you on present values or future values. I'll give them to you on your final. On your homework, you might get some, so you can test yourself on it, but I'm not going to make you do it for your homework. I mean, I'm sorry, my mind's fuzzy from me being sick. You're going to get it on your homework to practice, but on your final, I'm not going to make you calculate a future or present value. But in your future classes, you will, and I want you to be familiar with the concept, and it's a very interesting concept. I'll also test you on what the journal entries are on issuance of a bond, if it's at discount or premium. So we know what cash is. We know that bonds payables is a liability. And then if it's a discount, we're going to debit it. If it's a premium, we're going to credit it.